So I'm going to start with you, and I think this is a question that a lot of people are going to start talking about pretty soon. This rise in commodity prices, what does that mean for inflation? As I just mentioned, Fed officials, they were worried about inflation during those Fed minutes. As we continue to see commodities rally, does that get transferred into higher prices for goods?
The Fed's worry about inflation really stems from the service sector. Commodities contribute a lot to some of the goods pricing, but the goods prices themselves have been holding pretty steady ever since the beginning of this year. So I think one of the things that we're worried about in the inflation side is really on the domestic services side and not so much from commodities.
All right. The weaker dollar has been a big part of that commodity story. This week, again, dollar having its best week in just about a year. If we continue to see the dollar gain, does that mean that the commodities go down? Does that lessen the risk of inflation through commodities? I know you're saying it's mostly services, but commodities certainly factor into this, especially when we're talking about something like copper.
Oh, absolutely. But then remember the other commodity, which is oil, that has really gone down, starting to go down a bit as the tensions in the Middle East start to ease off. So commodities really have a mixed bag. Also, part of the strength in the commodity market represents the strong GDP numbers that we've had in the United States, which have a 3+ handle in the latest data. So I think the overall picture for inflation is one where the goods sector is holding steady, but the source of the real concern for the Fed and for policymakers is really from the service sector.
All right, Alastair, turning to you. I want to come back over to you. We've been talking a lot about this record rally when it comes to gold. Gold up about 50% year to date. There was actually a story in the FT earlier today that we were seeing increasing money go into funds that are ex-US. As a matter of fact, we were just doing an ETF segment earlier, the VXUS, the Vanguard Total International ETF that excludes the US, saw some of the top inflows. Just in general, what does that mean for the U.S. economy as we continue to see money go away from the dollar and even money that goes into the equity market go away from the U.S.?
Well, I don't think money's going away from the dollar. The fact that the dollar is strengthening shows that people are really exceptionally investing in the United States. But I think the gold story is one of central bank demand for gold. China is buying gold like crazy. India is as well. And I think what you see is a huge shift in the demand for gold on the part of central banks as part of the reserve currency. And Alastair's spot on about the impact of commodities for emerging markets. It's a very, very important factor for them and very specific to various countries and commodities. But for the United States economy, the fact that gold prices have gone up is not so much a dollar fear story or a U.S. fear story, but rather it's a reflection of central bank demand.
So, Bill, I want to come back over to you, just that conversation we're having about the dollar. In all fairness, the dollar index is weighed against a basket of other currencies. We've seen weakening in the euro and weakening in the yen, so that is part of the dollar's rise. But I want to hit on that point. If we see a weaker yen and a weaker euro, what does that mean in your mind for the U.S. economy and for a lot of companies that export over to Europe or to Japan?
It certainly is a mixed picture. And I think one of the things that we have to keep in mind is that a lot of the industrial economies like Japan, like Germany, are really doing quite badly in terms of economic growth. So when the dollar is strengthening, it's strengthening because the U.S. economy is doing well, the financial markets doing well, and people are wanting to invest in the United States and take money away from these other markets that are doing less well.